Hello, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, September 16th, 2021, and I am pre-recording this Trading Places Live for just a little bit later this morning. Currently, we have futures. Let's get the latest here. Futures are down a little bit this morning. We've had a kind of a rough start to September. We're actually going into the second half of September, which historically tends to be worse than the first half. But we do have futures down just a little bit this morning. Dow futures down 12, S&P 500 futures down 5.5, NASDAQ a little bit more on a percentage basis, down about 33, 34 points. So it does look like we'll get off to a little bit of a rocky start, then we'll see where we go from there. Let's go ahead and run through today's agenda. So we're going to start off with the daily market recap. Then we'll get into talking technically, going to look at the sectors from a little bit longer term perspective. Then take a look at transportation stocks. What's going on there? I'll show you a couple of interesting charts there. Then we'll get into a couple of tips and tricks dealing with CandleGlance charts, earnings spotlight, excuse me, and then we'll wrap up with the 3 you must see. All right, let's go ahead and get started. First, I'll take you over to earningsbeats.com. If you are new to Earnings Beats, love to have you come over here to earningsbeats.com. Scroll down right where we've got this sign up for the Earnings Beats Digest. This is our free newsletter. Simply type in your name, email address. Love to have you. No credit card required. You can unsubscribe at any time. We publish it 3 times a week. It's really just a way to get to know us, but we'd love to have you join the community. All right, moving on to the recap from Wednesday's action. The Dow Jones Industrial Average rebounded, but you can see we did that a couple of days ago. It didn't really work out. We went right back down. So we'll see what happens today, but we are trending below the moving average, that 20-day moving average. So right now, short term, we've got some issues here in the market from a technical perspective. Long term, I don't see any problems at all. Short term, definitely, we got to be careful. Dow Jones down 237 points yesterday. Up 237 points yesterday. S&P 500 up 38. NASDAQ up 124. Mid caps up 28. Small caps up 14. So even though we did have an up day, you can see all of our major indices basically still in downtrend. So got to be a little bit cautious here in the near term, and just knowing history the way we do, let's be careful here in the second half of September. Energy was the leader, big leader yesterday. And I've been watching about the 50.5 level. We did get through the 50-day moving average. That's good. So that's certainly a start. PPO trying to get through the center line. That's a start. But we need to extend this to the upside, and we need to get this breakout above, I'm going to say about $50.50. But good news was, at least yesterday, up almost 4% on the XLE. Very, very good move there. Crude oil prices now back up to $72 a barrel. That's no doubt helping the energy group right now. Industrials were up a little bit more than 1%. This is a group, it's just been kind of a head scratcher. And I'm going to talk a little bit more about the transports later. I think you'll find that very interesting. What I would say about the industrials, though, is we have a double bottom in here down around 99. Really do not want to lose that level. So if industrials do weaken the second half, just watch that 99 area. Breakdown there. I mean, we're talking about a multi-month low. We haven't seen too many of those recently anywhere. So you want to be careful if we lose that 99 level. Materials also up more than 1% yesterday, trying to hold this double bottom right here at around $83. Financials up just a little less than 1%. So these were your 4 leaders on Wednesday. Financials bouncing once again off of about that 37.5 area. 37 to 37.5, I think, at least in the short term, presents pretty good support for financials. The only sector, the only sector on Wednesday to fail to gain ground was the utility sector. Finished at 68.01. That was down 9 cents from the prior day's close. Trying to hang on around 68. We do have the 50-day moving average coming up from underneath. And when I look across all of these sectors, I mean, the one thing you see that's pretty common in September is the AD line going down for the most part in September. So there does appear to be some distribution taking place here. over the first couple of weeks. Sometimes you'll see prices go down, but the AD line will stay steady or even go up. That has not been the case here. So we definitely see the market getting much more defensive as we work our way through September. We do have still the worst 2 weeks of the calendar month to go. All right, 10-year Treasury yield. We got some economic reports due out later this morning. Initial jobless claims expected to come in at 315,000. Last week, 310,000. September Philadelphia Fed Manufacturing Index. August was 19.4. We're expecting this to drop to 19.2. But yesterday, we had the Empire State Manufacturing Index come out with almost the same expectations, and we blew the number out of the water. I mean, it was way higher than expected. I think the number expected was around 18.6, and it came in well up into the 30s. So we'll see whether or not we get the same reaction in Philadelphia this morning. August retail sales expected to drop 0.8%. July dropped 1.1%. So looking to continue heading in that direction. Some of the areas that would be impacted by retail sales, especially areas like clothing, accessories, apparel retail, those areas have been pretty weak. We've seen a lot of stocks in those groups getting hit pretty hard. So any kind of positive news could really help in that area. If we strip out the autos, retail sales for August expected to drop 0.1%, which is a little bit better than July's 0.4% drop. And then finally, July business inventories. I don't know how much you're watching July business inventories now that we're halfway through September, but they're expected to rise 0.5%. June had risen 0.8%. So those are the economic reports out later this morning. Obviously, quite a few of them. Retail sales will be watched very closely, as of course, weekly jobless claims are generally watched pretty closely as well. As far as the 10-year Treasury yield goes, we're just sideways consolidating. I mean, I sound like a broken record every day, but 140 to the upside, about 113, 114 to the downside. Until we break out of this range, I think it's just more back and forth with bond traders, just trying to figure out inflation, trying to figure out our economy. I can say this, normally the Fed would fight inflation by raising rates. So if the bond market, bond traders really felt like inflation was a problem, they would be getting out of their bonds. Also, you know, the Fed's talked about tapering. Well, if the bond market, if bond traders really believed the Fed was about to taper, they'd be getting out of bonds. Both of those would be sending rates higher. And we're not going higher. So I wouldn't worry about either one of those right now. Markets talked about tapering. The markets talked about inflation. I don't believe the market's worried. I don't believe Wall Street's worried about either one of them right now. In fact, the thing that bothers me, the reason I wish it would go higher is because I really think the market should be anticipating more economic growth ahead. And right now, we're just not seeing that in terms of rising yields. So that would be my concern with the yields not rising, is that the market, you know, and maybe the market feels like we can handle the rise in economic activity without having to raise rates. And that, you know, would be a good thing. But at the same time, it also doesn't really correlate with what we've seen in the past, which is higher yields typically driving equity prices higher, money rotating out of bonds and into stocks. All right, moving on to talking technically, I just wanted to go through and pull up a few of these sector charts. These are going to be some of the charts that really help to drive the stock market. So for instance, technology. Technology is the largest component within the S&P 500. One thing I just want to point out here, this is a log scale, logarithmic. Now, if you go down to the bottom of the chart here, if you uncheck that log scale box, some people use the arithmetic scale. I don't like it. Now, when you annotate, I'm going to show you the difference between the two. So if I annotate this chart and I'm looking at the rate that the market is growing, you know, from 5 years ago, you can kind of see we were just kind of going along in this straight line. Well, it makes it look like we've gone way, way, way above that mean, you know, where we should be. But the problem is with an arithmetic chart, look at the distance between 50 and 60. And look at the distance between 150 and 160. They're the same. Well, the distance here, this is only about a 7% increase from 150 to 160. 7%. From 50 to 60, that's a 20% increase. So on a percentage basis, if you use an arithmetic scale, it really makes no sense to try to compare. If the market goes up 9% every year, then your arithmetic scale is going to look great. It's going to look like you're in some sort of a bubble when you're really not. So let me get out of this. And I could go back. Let's go back 20 years, and I think you'll really see what I'm talking about. So look at this. It looks like technology didn't do anything for 15 years and then all of a sudden exploded. Now, if we move that back to a log scale and we go back to the last 20 years, since 2009, I think you can look and see that it's been a pretty steady move to the upside. That's the difference. I think anytime you're looking at a long-term chart, if you're looking at an arithmetic log or an arithmetic scale, I think it's going to be very, very misleading, very misleading. So you want to stick with the log scale. All right, let me go back to that 5-year chart. Kind of got off track there, but I wanted to point that out. Something I always think about and I hardly ever point out, but if you're using stock charts, I think that's really important. So what I see right now is, bigger picture, 5-year. Okay, here was the Q4 2018 trade war. Here was the pandemic for technology. And this is where we are now. It's like the trade war and the pandemic never really happened, which is kind of what I was calling for back in the year, back in 2020 during the pandemic. I said we were in a secular bull market, or I felt we were still in a secular bull market. And I don't know how you look at this, but if I just go back to where we were and then pre-pandemic, right about that high, and then just kind of draw along that line. So if we just say, okay, the trade war was, just a bunch of fluff. And then of course the pandemic, short term, yes, it was a big problem. From a healthcare perspective, it was a huge problem. From a financial perspective, it wasn't as big a deal as it was made out in the media. And you can see, looking at this chart, we've kind of gotten right back on track and right where we need to be. So are we overpriced here? I don't think so. I mean, maybe we'll pull back here in September a little bit just because historically we do. But I think the long-term perspective here on technology is still pretty bullish and I think continues to go higher. Now let's take a look at the XLY. And I think you're going to see pretty much the same thing. I'll just annotate one more of these. I won't do them all. But I mean, here, if you connect that pre-pandemic high, maybe, well, I mean, it's hard to say because, it looks to, if you went back and looked at the relative strength, consumer discretionary struggled for a while and then started picking back up after the, that month of the bubble or the month of the pandemic to the downside. We finally saw consumer discretionary start picking back up again. But again, if we go back to 2016 and connect the pre-pandemic high, that's kind of where we were before all this mess started, and then just kind of extend the line, you can see we're pretty much right on target. Maybe we're a little bit above, but perhaps September takes care of that. How about the XLC? XLC, I think there's been a little bit more volatility here. 2018, the pandemic, I mean, we were almost all the way back to where we were at the beginning of 2017. So I think we've played a lot of catch up here in the communication services area. But again, our trend remains perfectly intact. Financials and industrials, where it starts to get a little bit interesting, because financials, I think, probably are still a little bit under. I'm going to annotate this one. I'm definitely, well, I said I wasn't going to annotate, but I think it helps. If I take a look at where we were and then back pre-pandemic and where we are now, we're actually a little bit below the line on the financials. So it seems to me like maybe financials, which took a huge hit and took a long time to recover, I'm not sure they've quite gotten back to where they need to be. So from a longer term perspective, maybe we're going to see a little bit more strength out of financials going forward. And then industrials, which came back very strong all the way through May. Since May, we just have not been able to, the group hasn't been able to get out of its own way. And if we take that same approach, looking from back here and connecting that high, then you can see this is probably just slightly below as well, where we would be connecting the last 5 years and just on this trend line, on this upward trajectory. And again, this is using a log chart. So on a percentage basis, this is much more meaningful than an arithmetic chart. Anyhow, that just a quick look at the sectors for talking technically. Now let's move on to transportation stocks. This is these are two charts that I put into the daily market report for our members at Earnings Beach yesterday. And I went back and I was just looking at the S&P 500 over the last 50 years. This is a weekly chart going back 50 years. That's a long time. Transportation is in pink. Now, if you just glance at this, I think you can tell that transportation and the S&P 500 tend to go hand in hand. I mean, we have a little bit of movement away from one another. There's a pretty good divergence there. Maybe a little bit of divergence in here. I mean, you can see where the lines break away from one another. You get a little bit of divergence. And just recently, you can see the S&P 500 reaching new highs, and we've been struggling in transports, going the other way. And if you look back over a 20-week period, that's the default on correlation. And this is a weekly chart. So it's 20 periods. This is a weekly chart. So we're looking at the last 20 weeks. Okay. Now I'm going to go back over here for a second because I want to show you the S&P 500. 20 weeks is roughly 5 months, just a little less than 5 months. So if we go back from September, we got August, July, June, May, April. So here's the S&P 500. Let's just say from maybe the end part of April, we were at 4,200. We've seen the S&P 500 going higher. Since the end of April, early May, excuse me. If you look from that same period, end of April, early May, look at what transports have been doing. So this is what we're comparing when we go back and we look at the correlation between the S&P 500 and the transports. Take a look down here at the correlation. This is 50 years worth of data. We have never seen correlation so crazy between the S&P 500 and transports over a 20-week period. This is the most inverse we've ever seen. The only other time was in a bear market where we've been this low, anywhere close to this low. In 2001, just after the bear market got started. How about the other time it hit? 2006, which was just before we went into a bear market. So is this telling us that we should be getting out, that this is a bear market? Well, I thought what I would do is just say, okay, yes, the last 20 weeks, we've definitely had inverse correlation. But what I wanted to do was to go out and stretch it out. Let's look at a monthly chart, because then when we pull up a monthly chart and we look at correlation, we're going to look at 20 months, not 20 weeks, but 20 months. And I wonder, how that looks. Well, here's how it looks. We're almost at 1 in terms of positive correlation. So while the 20-week period, we've been as inversely correlated between these two indexes as at any other point in the last 50 years, if we stretch it out and look at the big picture monthly, there really hasn't been much. I mean, we're still very positively correlated. So is this just a short-term blip, I guess is my question. If you're bullish the stock market, you have to believe that this is a short-term blip. Now, we've seen movements into negative territory many, many times. And every time we go into negative territory, that doesn't mean that there's a bear market. Okay. So the other thing you have to understand is we're coming out of this pandemic where everything is just turned upside down, and you're trying to figure, all of a sudden inflation seems to be out of control. I don't believe it is. I just think that a lot of what we're seeing here on this weekly chart has a lot to do with the craziness surrounding the pandemic and the recovery out of the pandemic. and the crazy rotation. I suspect at some point, and I don't know when, at some point, I believe this will right itself and we're going to see transports take back off to the upside. And the longer term monthly chart would support this. The only time, I mean, I want you to look back at the times we have had in the last, well, since 72, so 71, 50 years. The only times we've gone down to negative correlation over a 20-month period here at the start of a major bear market. That was the end of a huge secular bull market. Done. The other time here, this was about at the end of the other secular bull market from the 50s and 60s. So is this something maybe we can be looking for later? I mean, you can see here, this was 2008 when we had the financial crisis. This is kind of a interesting chart from a long-term perspective. So with us sitting still up near 1, I guess my point is, it still looks to me like we're okay with the market. I wouldn't be too overly concerned at this point, but if transports don't start to recover, and if this morphs out another 20 weeks, then yes, we could be looking at something that is much worse. Now, I'm not seeing any other issues with the market. So, and this one, I never had really looked at the long-term correlation and the impact that this might have. So this is something maybe to keep a chart of. If you want to take a screenshot, just see how I have this set up. Just a monthly chart, solid line. I've got the price transports behind the S&P 500. It's got a pink color there. And then here with the transports correlation. And so anyway, you can set this up if you'd like. Maybe keep this as a chart in one of your chart lists to take a look at later. All right. Let me move on to, let's move on to tips and tricks. So I want to just go through CandleGlance charts with you. I've had a question come up about CandleGlance. And, and how I set it up. So when you're looking at that very first chart, had a question come up. Okay, how do you set this up? So let me just walk you through what you have to do. If you're over here, actually, let me go ahead and just pull it up on this chart. So if you're over here and you, first of all, you just have to set up the chart and the way you want to see it on the CandleGlance. So is this the chart you want? You want to do kind of like I did. I think I did a 4-month chart. Actually, let's just move it to 6 months. Let's do a 6-month chart. We'll leave the PPO and I'll just, do it like this. 6 months with the PPO on top and the AD line down below. Or let me just show you another way. Maybe what you could do is, how about we use, price, and then we use, well, let's do a chart here of a stock. Let's do Apple. And then maybe we just want to compare it, say, to the S&P 500. All right. So now we've got this chart set up this way. Now, let's say this is the way you want to set it up on the CandleGlance. All you have to do is go down here and hit this plus button. And now I already have CandleGlance set up, but when I start to type it, it'll come up. If you don't already have this set up, then you just type in just like this, CandleGlance. And I hit replace, but you'll hit add new. There'll be an add new button. So I hit replace, same as your add new. And now that's my CandleGlance. So if I go back over here, well, it's not going to work out because I don't have individual stocks. That's not going to be a good idea. But now let me go in here and let's pull up a chart list. I'm trying to find a smaller one. We'll do the seasonality chart list. So the seasonality chart list that I have here has 20 stocks on it. So if I pull this up in CandleGlance, Now I've got the PPO, I've got the 6-month chart, and there down below, I've got the stock relative to the S&P 500. So all you do is you set it up however you want. And then when you're in the chart, once you set it up, then you hit the plus button and type in CandleGlance and hit add new. If you've already got CandleGlance, then you're going to hit replace. Now I'm going to have to go back and change my setups, or I'm going to have the same thing next time I do the show. But that's how you set it up. All right, let's move on to earnings spotlight. I didn't really have a whole lot because earnings have slowed down to almost nothing. So what I've done here is I've just pulled up my strong earnings chart list, which if I pull it up in edit form here, you'll see that there are 583 companies on this list. Over the last 90 days, these are the companies that have beaten Wall Street estimates as to both revenue and earnings per share. They're liquid, and they either looked good technically at the time that I added them onto the chart list, or they were part of a group that looked good. And what we can do is we could pull these up in CandleGlance if we wanted, based on what we just set up. And we could go through 30 charts in a row. Maybe you're looking for stocks that are really strong versus the S&P 500. So you might say, hey, I want to look at INFO. And then down here, look at ACN. Accenture has been very strong versus the S&P. Or if you're looking maybe to short, look at the ones that have been weak. So that's just a couple of ideas. But using the strong earnings chart list that we provide our members, that can be downloaded straight into your StockCharts account. Easy way to be able to quickly identify some candidates for trades. All right, let's move on to the 3 you must see and wrap up the show here. I'm going to start off with Occidental Petroleum. Energy's been strong. And I know Oxy got up here at a couple of tops around $32, $33. Looked like we were breaking down below the recent lows. Got a really big head fake on energy. And now we have started rallying back in energy and moved back, in case of Oxy, back above both the 20 and the 50. And we're just about to get this golden cross with the 20 back above the 50. Now, we have seen these crosses on multiple occasions during this period of consolidation. And that's what this is right now. So I'm not making any long-term bullish calls, but short-term, as long as we stay back above the 20-day moving average, I'm okay here. If we roll back over, I would be much more bearish. So you want to at least keep that in mind. Next up, TGNA. This is Tegna Inc. I like the volume that came in this breakout. This is a stock that had been downtrending for a while. I don't know that I'd chase it after an 8% move, but if over the next week or two we pull back and we get closer to the 20-day moving average, I think this is a stock that'd be interesting to take a look at. It is in the publishing area, and if you come down, publishers are right near a high for its last 52 weeks. So this is a pretty good group and a strong stock. And the last one I'll mention is Bungie BG. This one also, after going down sideways, consolidating for a while, you can see it break back up. Very strong move here. The thing I like about this one, look at the AD line. While prices kept going lower, it didn't seem like it was being distributed. So the fact that we're now confirming with a heavy volume move back to the upside, I think is pretty bullish. All right, that's it for me. I appreciate everybody tuning in. Join me again on Trading Places Live next Monday over at earningsbeats.com. You can get me there Mondays and Wednesdays, Tuesdays and Thursdays here at StockCharts TV. All of the shows at 9 a.m. Eastern. Listen, have a great Thursday. Enjoy the rest of the week. Have a great weekend, and just be careful. Second half of September is upon us. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.